This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self-Storage Podcast. I'm your host, Scott Meyers, and on this week's episode, I thought I'd share the opening session to our most recent Self-Storage Academy, where I shared our approach to both the business as well as the market cycle we're heading into, our specific plans for 2023, and the opportunities that we see in the marketplace, and really what we've learned over the past 15 years in the business. We had the largest group of investors in attendance since COVID, and they were fired up to go out and storm the gates after spending 3 days with the best team in the business that has helped more people than anyone else on the planet learn how to start, grow, and scale a self-storage business. The energy was just absolutely infectious, and although this is a paid event, I thought it was too good not to share. So without further ado, here's a peek behind the curtain on day one of the industry's premier education and networking event. All right, so good to be here. It's so good to get a round of applause when I haven't even said or done anything yet. That's a good way to start out the day, so thank you all for that. A lot of information I want to share, so make sure you take notes. Don't count all my ums and ahs or anything else, because I am not a professionally trained speaker. I am an investor who stands on stage and will do my best to give you as much information as I possibly can about our best business practices so you can do the same. So take notes, stick with us. Lots to say, a whole lot that I have to continue to curb my enthusiasm for what we're feeling right now, what we're seeing in the business and in this industry. We chose this industry for a reason. Part of it was because our back was against the wall and we didn't really like the tenant toilet trash business. We needed to find something else. But then when we chose self-storage, we chose it for the reasons that we're enjoying right now, which is because it is recession, I won't say proof, but resistant and resilient. It is inflation proof. We are heading into a time right now that has us all very, very excited. As Amy has mentioned, this will be the biggest land grab in my entire lifetime, and this is going to be the one that sets the stage for what we do in our lives for the rest of our lives. And so I'm excited to share that with you all because it's finally here. We've been preparing for this since 2008. At that time, we did very, very well, because we were in self-storage. So the recession of 99 and 2000 did not do very, very well because I was in houses and apartments. During the 2008-2009 recession, we recognized pretty quickly that I wish I'd have had more capital. I wish I'd have had better lending relationships and more partners to be able to do more deals, because we did very well, but we also saw some of the folks that were 5-10 years ahead of us who had those lending relationships, who had that additional capital. Those are the ones that also had a huge land grab and made out very, very well. Then when times were good and they were developing, they were buying, and then they were selling off at that point or refinancing and moving on. So that's our business model in a nutshell, is to buy as much as possible we can right now, develop as much as possible right now, and then when interest rates come back down and cap rates come back down, we will be in a position to either refinance, recapitalize, or to sell at that point. So my background, most of you are probably familiar. If you Google, you'll find, 30,000 plus pages on who I am and what we do. But to sum it all up, live in Indianapolis, Fishers, Indiana, not married to my business partner, but my wife is my business partner. We built these businesses together. We have 3 amazing kiddos and 1 very average dog that is theirs, not mine. 1993 to 2005, we bought and sold 82 single-family homes, 423 apartments, thinking we could grow and scale that to the place where we would have the freedom and the cash flow to do what it is that we wanted to do, only to find out that it was just more headaches. It just multiplied as we went along. And even though we had systems in place and we had management companies and managers managing it, the buck stopped here and the check all came here for me to sign for all those hassles. We just recognized and realized that we didn't want that. So we got into self-storage. That's in 2005, bought our first. And since then, we've bought, converted, developed, now approaching 16,000 units and over 2.5 million square feet of self-storage nationwide. We do this all over the country. We've raised over $68 million from our 450 plus private equity partners. And now we're moving on to family offices and larger institutional funds and money. I'm getting ready to embark on a trip over to the Middle East, over to Dubai and Saudi Arabia in January to visit several family offices in order to grow our private equity, because it is our Super Bowl and this is the greatest land grab of my lifetime. And so we're going to raise even more equity to go out and take advantage of what the market is giving us, the gift it's giving us right now. In 2007 is when we really founded this business. I began holding workshops as the president of a real estate investment club in Indianapolis. When my wife and I started this business, we wanted to have that freedom and flexibility that just about everybody wants to have. We wanted to be able to take vacations whenever we wanted. We wanted to pull our kids out of school and have our kids see the world rather than read about it. And we didn't want them to get dinged from an attendance standpoint or a grade standpoint for doing so. We wanted to take them to Washington, D.C. and spend a week there rather than reading about it. We wanted to go to Costa Rica to understand and what it looks like to live in Central America. Those are the things that we always wanted to do. We didn't want our kids raised by anybody else or influenced too much by anybody else. And Self-storage was the avenue that made that happen. It wasn't the houses and it wasn't the apartments. And then the bigger piece of that is that we want to go on the mission field, and we wanted to go out for a week at a time. And then we decided we want to go out for 6 weeks at a time and be off the grid with no access to anything or anybody. And that doesn't happen when you're in the tenant and toilet business, because there's always somebody that needs something. But it happened once we got into the self-storage business. My wife Christina said, when we sold our last apartment complex, it was a 70-unit apartment complex, and we got rid of everything. That was the last of the residential real estate, essentially, even though it was commercial, but tenants and toilets. She goes, what do you notice today? And guys, that's a loaded question when your wife comes in and says, hey, do you notice anything different today? Beautiful dress, your hair looks fantastic, you've lost weight, I don't know, tell me. She says, it's quiet. It's quiet. And it was noon, phone hadn't rang, with contractor issues, with tenant issues, with toilet issues, or whatever else. And has continued on since then. I mean, it doesn't mean that we don't have challenges in the business, because we do, but we didn't have those challenges anymore to get in the way. We've learned from the recessions in 99 and 2008, and we can't wait for number 3. And depending upon who you listen to, we're either in a recession or we're heading towards it. So, two quarters of negative economic growth, and we're in a recession. So we're heading into it with inflationary periods and what we're seeing right now in the slowdown, and also labor rates, unemployment rates. We're in it. We're acting as if, because we're seeing the dynamics from an economic standpoint, and from an inflationary standpoint, and from a monetary standpoint. So we have deployed Plan B, and we're in it right now. So why are we here? Why are we so excited? Because it's here. The self-storage Super Bowl has arrived. We thought that the recession, the economic recession in our country, would occur 3, 4, 5 years ago. We kind of skipped over a cycle, essentially, but it's here. And we've been preparing for this because self-storage, for those of you that have been watching our videos or following us or following the industry in general, you recognize it's up and to the right. When times are good, people buy more stuff, they run out of room for stuff, and so they put it into storage. That's when times are good. Everybody's buying things and things are looking good. But then when we hit a recession, people downsize, businesses downsize, and then they have to consolidate, they have to downsize, they have to move in with somebody else. Well, there's stuff they don't want to get rid of. From a business standpoint, they've got inventory, they've got furniture, they've got their office that they need to pack up until times are good again, and then we get a spike. The hockey stick effect comes into effect in self-storage during a recession. So we don't celebrate pandemics, we don't celebrate a recession. There's a whole lot of bad things that happen during those times, but in the storage industry, yeah, we're kind of happy about that. We're secretly applauding because this is what that looks like. We know the business, it goes like gangbusters at this point. The banks, they are challenged to make loans on development projects. That's a little more challenging, which only means that there's fewer facilities being developed as we head into a recession. There's an increase in demand, and that puts pressure on rates, which is good for those of us already in the business. And for the opportunist to go out there and find facilities that are for sale, well, there's a whole lot of owners, these mom and pops, that are now getting scared because we're in a recession, and they're thinking, is it time to sell? And not only are they thinking that, but they are selling. This is the perfect storm that we're heading into every time we head into a recession. How do we know this? It's my 3rd recession. We're very seasoned. We know the markers. We can see out a little farther than most people. We don't know exactly what's going to happen. Every recession is different, but we certainly know what happens every single recession in our industry. And so strap in. We're going to show you exactly what that looks like and how you can take advantage of it and why you should be taking advantage of it right now. Time. It's everything. The time is now. There's no reason to wait. Don't wait for anything else. Or, first of all, turn off the news. Stop watching the news. I've been on a media fast since 2006. I read The 4-Hour Work Week by Tim Ferriss, and although there's a whole bunch of good life lessons and business lessons in there, one of the big takeaways was, hey, let's go on a media fast. And so I did that. And so I stay away from the negative stuff. If you're one who is susceptible and, first of all, believing everything, and then also doing what they say you should be doing, which is pulling back and waiting and doing whatever else, well, great. That means that there's more for the rest of us that are tuning that off and just going forward, because we know what the rules are. The rules are, here's the cost of our capital. Here's the cost of our money right now. Okay, there's inflation. It's 6% now, and it used to be 3%. Great, I know what the rule is. It's 6%. I'm still going to apply my best business practices, and I'm going to underwrite based upon my cost of capital now and plow ahead with less competition. The business model doesn't change. It's just my cost of capital. That's the only thing that we change in this time right now. So you're in a perfect place. We're in a perfect position. We have been excited about this. We don't pretend to know everything in the industry. We follow the big guys. Many people, as they come through here, and myself in the beginning, we thought, well, how can I compete with the big guys? They're just going to always cut rates. And why would I develop anywhere near a Public Storage or a U-Haul or a Extra Space or, any of these others? And it's like, well, you know what? We sell to them. We develop facilities and we sell to them. We reverse engineer their business model. We watch what they're doing. And then we implement that and put that in our business. And we become masters of that. Yes, we have our own standard operating procedures and things that we've learned along the way that work well for us and in the markets that we operate, but we also follow these folks very, very closely. We operate in a sandbox. We play in a sandbox just below the big guys, below the REITs. REITs are real estate investment trusts, and they're the public companies. They're the big guys. It's the public storage, the Extra Spaces of the world, the Life Storages of the world. So we take a lot of cues from them. We learn a lot from them. We partner with them. We sell facilities to them. We buy facilities up from them as well. They are not the evil competition. As a matter of fact, they're your customers. They're going to be your customers, and we can learn a lot from them as well. Public Storage wants to sink $1 billion into buying more properties in 2022. Should we be thinking about buying more properties as we head into a recession? Well, yeah, if the big guys are doing it, then absolutely we should too. Bank of America upgrades self-storage REITs as we head into a recession, not pulling back, not declining. Wall Street knows, the market knows, we as investors know, the self-storage does extremely well during a recession, and that's what we're heading into right now. Blackstone agrees to buy Simply Self-Storage from Brookfield in a $1.2 billion deal. Private equity has now recognized that, self-storage is not just this Cinderella stepchild, what was the stepchild of commercial real estate, and now has turned into the Cinderella because it does so well. It is very profitable. It works during inflationary times. It does better during a recessionary period. And what used to be these ugly boxes on concrete slabs has now become the belle of the ball. It is the Cinderella. Recession in 2022, U.S. self-storage says bring it on. U.S. self-storage meaning the industry. Speaking with the experts in the industry, bring it on. We can't wait. We've been waiting for this. So what does that mean right now? Well, it means we again have to be smart about what we do. We're underwriting to the market. We're underwriting to our cost of capital. And we've now come to that place where interest rates are going up. And although there's always a lag in self-storage because there's so much competition, people looking to buy and get into self-storage, that once interest rates go up, it takes a little while before the market in self-storage cools down. But we're seeing it now. We're seeing a price reduction on some of these properties. So there's less competition, there's fear. And so what that does is that's weeded out some of the looky-loos and some of the other folks that really weren't that savvy in the business to begin with and maybe didn't have a lot of experience. And now their lenders are saying, yeah, we're going to fund a whole lot of deals for you right now, even though we like self-storage, but you don't have a whole lot of experience and we don't have a market that is just going to take you and move you on through despite your experience. So we're seeing less competition from your fellow investors out there. And so we're starting to see price reductions. Do we like to see price reductions? Absolutely. Are we selling right now? Absolutely not. We're holding right now. Are we buying right now? Absolutely yes. There are folks that have to sell. There are some folks that they've raised private equity like ourselves, and they've got a 5-year stop in which they need to sell out of that fund, that syndication, that private placement. They have to sell right now. Are they going to take a haircut? I don't know. Depends on the projections that they set forth. Are there some folks that are facing a refinance right now because their adjustable mortgage came due? When they bought it at 90% LTV, loan to value, and now the bank is only going to refinance it at 65% loan to value because the banks are a little nervous about where we're going and the interest rates are higher. Some of these sellers are having to take a price reduction. They have to sell because they can't refinance because they didn't build enough value, or they may have to come to the closing table with cash. You bought it at 90% LTV, you didn't build value into it, now you're going to refinance it at 65% loan to value, and at a higher interest rate, you may have to come to the closing table with cash, or you're going to come to the closing table with the keys because you can't afford it at the new rate structure, at your new cost of capital. We saw this happen over and over and over again in 2008 and 2009. That is the reason why I wished I would have been better at raising capital and having lending relationships, because now we're in a place where we have that. When those folks come to the closing table with the keys, we're going to catch them. And we're going to step in there and either help partner with those folks, bring in some capital, or we're going to buy them, whether it just be outright or in a short sale, or make any type of arrangements with the lender to say, yeah, we'll take that so you don't have to go through foreclosure, do a deed in lieu, protect that person's credit, whatever that looks like. So the right time is now as we hit into this recession, because we saw what happened during the pandemic. And what the pandemic did was, those that haven't been through a recession, a glimpse into what happens in self-storage and commercial real estate during a recession. Because a lot of those underlying fundamentals, things that occur during a recession, happen during a pandemic. Businesses shut down immediately. The entire country was shut down, right? And so there's some small businesses that went out, they just shut their doors, then they couldn't withstand. Some of these businesses, they couldn't stand a week without sales. They certainly couldn't stand 30 days, let alone a year. So they took their inventory, they took their equipment, they took their furniture, and they put it into self-storage. When people were sent home from work, those businesses did the same thing. They had to give up leases. They had to give up their office space and put things into storage. But then what happened on the other end is these employees came home to work, right? Maybe some of you. And then you and the rest of the folks, they had to clear out, well, maybe the formal dining room, another bedroom, a place in the basement to make room for now a workspace in a household with 2 income earners to make a place for 2. Then the kids came home from school and now you had to set up school in your house. And so you had to get rid of more furniture and make more room for school and for work. And that caused a huge increase in demand for storage. Self-storage was deemed at the time also an essential business, which means that it didn't shut down. Also, for those of us that are in the industry already, or were in the industry already, we had facilities that were set up to be unmanned, which means that we had a kiosk in place. You could rent a unit online, get a key code, or get a key fob and pick it up and get into your facility without ever coming into contact with an individual, because human contact was deemed to be bad at that time, right? Or we had a kiosk that was set up in our facility so you could come in, you could walk into an office, it's more like a vestibule with a kiosk, and you could rent a unit online via the portal that we have sitting in our lobby, get a key code, get a key fob, get a lock, and go out to your unit, again, without ever coming into contact with a person. So if you didn't want to. That's been in our industry for a number of years, and then those that are in the industry that hadn't converted over to that, they did so very quickly, and self-storage didn't skip a beat during the pandemic and capitalize on that increase in demand. So for all those reasons, that's why we love self-storage, and that's exactly what's going to happen as we continue to go deeper into this recession. Businesses downsize, people downsize, and now there's people back in the offices again, but you don't have to, and it reduces your payroll. Virtual work allows freedom to move. In self-storage, we are in the trauma and transition business. When there's trauma, people's basements flood. When there's death, divorce, bankruptcy, all of those create a need typically for storage. Transition simply means you're getting ready to, you want to sell your house. The realtor says, the agent says, get all your kids' toys and everything else out of here that you don't need and put it in storage so it makes the house look bigger. So they utilize storage at that time. And then when you sell the house and you get ready to move, you either rent another one or you rent one near your new home. And that creates a demand, more demand for storage. When people are moving, a move necessitates a need for storage. Now with the pandemic, what we've seen is that there are so many folks, so many companies that recognize we don't have to go back to the office. People can work from home. We trust that. We've seen the productivity. And so now they're reducing office space and people are saying, I don't have to live in this city or this state because my job is here. I've got the freedom to move back home. I got the freedom to move wherever it is that I want to live and then do business from there. And so that's why we had the huge migration to Arizona, to Florida, to the southern states, to whatever that looks like. And that has created another demand for storage. We got 10,000 baby boomers retiring daily. For those of you that have been following me long enough, I've written several articles and we've looked at how the baby boomers have created a demand for storage because as they're aging, they're downsizing, then they go into assisted living and then they pass on and their estate typically goes into storage because their kids really don't want all that stuff, but they can't get rid of it because it's mom and dad's stuff. And we got to keep it because it's an heirloom. So we're seeing that effect. And millennials also driving demand, which this is a big fear by many folks who are not in the know in our industry, thinking, well, these millennials, they just want experiences. They're building and living in these tiny homes. What is a tiny home anyways? Well, yes, the millennials are more minimalist in nature and looking for experiences. They may work for a little while and then travel for a little while, work for a little while, travel a little while, move around. Well, those experiences usually come with toys. They come with kayaks, they come with camping gear, they come with motorcycles, you name it. And if they're living in a tiny house or an apartment or a condo, there's usually not room for it. So the millennials are driving demand even greater than the boomers. And as they are moving around and being transient, same rules apply that we just talked about. RVs and boats are sold out. That's changed just a little bit now. However, for years, there's been a waiting list for RVs and boats, and they all got to go somewhere. And there's been a huge increase in surge in demand for RV and boat storage. The demand versus supply of RV and boat storage has far surpassed traditional storage, meaning under roof in a 10 by 10, in a 10 by 20. And we're still seeing that. Many folks are saying, okay, well, that's going to end and we're heading into a recession. So that's all going to go away. Well, is it? I mean, if somebody gets over their skis and they can't afford an RV and a boat, where's it going to go? Well, you have to sell it or the bank's going to take it back. But then what? The banks aren't going to park it in the parking lot or the new owner is not going to be able to park it on the street because their homeowners association says they can't. So it still has to go in storage. So all this fear about, oh, that's all going to go away. Well, these things aren't going to go away. They have to go somewhere. They're not just going to go to the crusher, brand new $750,000 RV that somebody, the bank takes back or they sell. It's still got to be parked somewhere. The demand is still there. And as a matter of fact, there's greater demand because the supply increases and there's less storage being developed right now. So if you're looking for another business model within our business model, RV and boat storage is definitely one of them. So how do you take advantage of what's going on in the marketplace right now? Well, master market and deal analysis. You need to master your market. supply and demand levels, and then you need to master deal analysis. There's two pieces to looking at a successful project and an acquisition or a development, and that is how much are you paying for the deal itself, for the existing facility or development. Do the numbers make sense? How much does it cost to buy it or build it versus the rental rates in the market? And at 85 to 90% occupancy, does it generate enough to pay the loan at the cost that you paid for it or built it? It's as simple as that, but there's about 150 different steps and calculations in between here and there. Then the market. I bought an existing facility and it's only at 60%. I'm going to take it up to 85. Well, is the rest of the competition all at 60% in your market or in a 5-mile radius? Well, you're probably not going to take it up to 85. So you need to understand the dynamics in the market as well. Buying existing facilities. This is the easiest and quickest way to get into the business, which is where most of you are going to start because the banks want to see not only the historical profit and loss and a track record of the facility in addition to you as a borrower. But the best way to get into the business is to say, hey, this is what this facility has done over the last several years. And yes, I may be new to the business, but I know that you're lending based upon this facility versus my personal credit. And they do. They lean on that more than you personally. So you can become a wholesaler. You can seek partnerships and joint ventures. To the extent that you can't do it on your own, seek a partnership, seek a joint venture. If you can't get across the finish line because the lender says you don't have experience, you don't have enough cash, whatever, don't let the deal die and fall off the table. Call us, partner with someone, do a joint venture. Syndicate and or start a fund. The growth in any company is usually only capped by the amount of cash that you have available, either from the profits from the operations or from outside capital to be able to grow and scale a business. So, rent changes from 2019 to 2022. If we're talking about a market, there's a couple approaches. First of all, we suggest you start in your backyard. There's folks that always feel that the grass is greener somewhere else. One of the questions is, all right, Scott, where's the best markets? Where are you investing right now? And I will say that you need to begin looking within a 2-hour drive of where you live right now. And I would bet that you're going to uncover opportunities there. You don't have to travel the yellow brick road to find self-storage Oz. It's not out there. It's in your backyard. Top 10 markets by population growth. Those are the areas in which people are moving and migrating to. Just to break it down, Austin, Las Vegas, Phoenix, Orlando, Raleigh, Dallas, Fort Worth, Salt Lake City, West Palm Beach, San Antonio, Charlotte, versus an average in the U.S. of about 1.4% 3-year population growth and a 3-year inventory growth of 10.2%. So these are some of the markets. If you're in some of those markets right now, in those high growth markets, congratulations. Literally the tip of the iceberg. Our 15-year average IRR and our team is double the market. So we are doubling the returns for ourselves and our investors compared to the rest of the market. And who is the rest of the market? Well, it's all of our competitors and the REITs. We're doing pretty darn good at what we do, guys. Downside protection. Another reason why we love self-storage is because, yeah, it's the most profitable, and it would go to say that most likely it has the best downside protection. But if you look across different asset classes and different industry sectors, it's not the case. But in real estate, self-storage also, during 2007 to 2009, negative 3.86% as an industry sector. Multifamily, down double that amount. Retail, 12.32. Office, and then the S&P 500 tanked 21%. So again, we say inflation resistant and recession resistant. Nothing is recession proof because there are a whole lot of folks in our industry that didn't do well during that period. I can honestly say that this category did not reflect on our returns. We did not contribute to that. Everything was during that time frame. But there's a whole lot of folks that went out there and they just didn't understand what they were doing, and they did lose it. They didn't keep an eye on their capital. They didn't keep an eye on refinancing. They didn't create value, and they lost their facilities, and we bought them. Those are the folks that contributed to this. But that's not going to be you guys, because you're on the front. But that's not going to be you guys, because you're on the front. You're on the front end of this. $100,000 invested in storage in 1994 outperformed multifamily by $2,215,650 and the S&P 500 by $3,494,170. The source, National Real Estate Investment Trust. So if you invested in a REIT during that sector during that time in any of these other sectors, that's what you can expect. Now again, I'm not beating up on multifamily or any of these others. You know, I made money in multifamily. I made money in single family houses, but man, I think everybody ought to have an arrow in their quiver that is labeled self-storage. It doesn't mean you need to do what we did and sell everything and have everything in your portfolio be self-storage. But if you don't have one right now, you need to make a plan to have at least a self-storage facility in your portfolio for this reason only. So if you want to win in the investment game and the real estate game, this is the asset class you need to be in. I mean, the stats don't lie. As I said before, I'm not here to get you excited about self-storage. I mean, if you want to be on the winning team, this is it. It doesn't mean that you can't make money in these other sectors. It's just that your chances are a little bit greater that you're going to make more money being in the sector that profits the most, that is doing the best. The market is changing. Major shifts in the market means that we need to shift gears, and we are excited. Wall Street Journal says investors are moving into storage units. It doesn't mean that they're going broke and they have to live in them. It means that they're investing in them, so don't take that the wrong way. Investors are flocking to self-storage, says the Wall Street Journal. Self-storage survives COVID-19 so far. It doesn't survive, it actually thrives. How the coronavirus hit commercial real estate? Well, self-storage, no surprise, came out on top. Least affected, most profitable compared to all the other asset classes. It is pandemic resistant. It is recession resistant. It works well. She said it, Alice Chung, not me, the recession-proof sector, and for the reasons why. Has the highest returns over a 10-year period, looking back at the last recession, and we're poised to head into another one again. So we're preparing for the storm that's going to occur in the market, in our economy. It's going to be competitive. We got a competitive landscape out there right now, but there's going to be fewer competitors. Because again, the folks that aren't savvy enough, that haven't prepared, they're exiting. The challenge for those of you beginning now on the front end is where to find capital. The mistakes that you make in commercial real estate have more commas and zeros behind them. We're talking about more commas and zeros in a deal, and so those mistakes are a little more painful right now. And I include mistakes as just stuff that you don't know. You don't know what you don't know, and you missed out. You paid too much for something, or you could have exited, you could have made more money, you could have bought it for less, whatever that looks like. I mean, mistakes doesn't mean a failure. It just means that you made some mistakes where you could have made another 10 grand, 100 grand, or another $1 million on this project, and we've seen that happen many, many times. And so lean in. We got a correction going on right now, heading into a recession, depending upon what you want to call it or where you think we are, but we're heading into it. It's hard to build a team. It is. I can't put it any other way. This is a simple, predictable business model, which is one of the reasons why I got into this business, is because I like things that are simple and predictable. And if I can just perfect that, that's much greater than going out and creating something or inventing something to make money that way. You need to storm-proof your business because we're heading into a storm. So this means anything that you have right now in your portfolio, what you're preparing for, you need to be looking at the cost of capital. You need to be looking at all factors that could affect your portfolio right now and not bury your head in the sand and assume everything's going to be great like it has been since 2009 or 10 when you got into the business, because it's not. It just isn't. How is storage affected? Well, it involves need-based spending, which is both good and bad, meaning that there's a need for storage. That's great. However, the bad part is that we can't generate demand. We can't put a Val pack out and have a coupon for storage. It's like, ooh, they got a sale, first month free. Well, if you don't need storage, you don't need it, right? You can't generate demand. It's driven by market factors. The good news is we know how to get in front of that traffic better than just about anybody else out there. Loans with recourse could be called due. If you haven't looked at your portfolio, just understand some lenders right now are looking for reasons. If you got an arm that is overdue, they can pull that loan. If you've gone outside of your covenants for whatever reason, there's lenders right now that are calling loans due just because they want to shore up their balance sheet. You're fine, you're good, you're all caught up to date on your payments, doesn't matter. The bank wants to call a loan due, or if it gets sold and there's something within the covenants that allows them to take it back, they just might. Ask me how I know this. Some partnerships will be strained, right? We hit into recession, marriages that are strained, there's business partnerships that can be strained as well. And we have been the benefactor of many business divorces. It presents an opportunity for those that are prepared, and that's you. Surround yourself with good data and good people to make the decisions. It is the wild, wild west out there, and we've seen that for the past several years. And what do I mean by that? And that is there's so many people that aim, or they can't get the gun out of the holster. But we also have a whole lot of folks out there, and maybe this is you, that is just shooting at everything. Hope it sticks. Spray and pray. Those are the folks that we're going to be buying their facilities from in the future. And so we want the opposite of that as well. But it's much easier for us to be able to, as any race car driver coach will say, it's much easier to slow somebody down a little bit than it is to get them to go fast. And so we don't want to discourage you if you're moving fast from anything, but just don't be a gunslinger that's just throwing stuff out there all the time. You need to learn the proper tools, lean in, listen to the resources, pay attention, turn your phones off, because this is our one and only goal. It's pretty simple. Total self-storage, world domination. That's it. It's coming to fruition. So we're not going to compete with the REITs. We sell them. I don't want to become a REIT. That, never say never, but I don't want to become a REIT, a publicly traded REIT. We don't want any part of that. Mom and pops, we're not going to buy these really small facilities. We've graduated from that. We're buying from those folks. But right now, we have the greatest land grab opportunity of our lifetime right now in this sector, because one thing I haven't mentioned is that compared to all the other asset classes, they're mature. 80% of mobile home parks, apartments, retail, all those other commercial asset classes, 80% of those are owned by the REITs, by the national firms, by the public companies, and 10 to 20% is owned by mom and pops still in those other asset classes. In self-storage, it's the opposite. 80% is still owned by mom and pops, 20% owned by the REITs. So we had the opportunity to go out and negotiate with those mom and pops, buy from them, and then we roll them up. And then we sell to the next bigger player or to the REITs, whether it's an individual facility or a group or a whole community that decides to sell their properties together, either all at one time or in groups or in tranches. And the reason why we like that and why we want to do that is because there's more profit in it. When we sell a group of facilities to a larger player, they're going to pay a higher multiple for that because they don't have to go through and do these individual transactions. So we net more as a group than we would if we were to sell those individually. And for somebody who owns 2.5 million square feet, if I can add to that and have somebody else sell their facilities along with the group that I'm getting ready to sell, and I get a greater multiple on that, that benefits all of us. So this is a community. This is a non-competitive community. I want you to understand and begin to wrap your head around that, moving forward together. And the goal is total self-storage world domination in our sandbox where we play. We don't play with the REITs. We're not mom and pops anymore. But in this sector right here, that's the competition. And we want to build a community that trumps the competition, as I mentioned before. And anybody that comes into this community is going to do that. And we're going to sell off to the REITs at some point. That's the goal. All right, our plan. Moving faster in 2023, growing our back office operations, more syndication and partnering, more acquisitions, and we're going to open source our business to grow the community. That's the plan for 2023. We're going to do it smarter. We're not going to do a ton more in terms of actual transactions, but we're certainly doing a lot more in terms of size. So here's the opportunity in the industry right now. It's missed by most people because it's usually dressed in overalls and looks like work. Who's that? Mr. Edison. Anybody who's read his book or understands what he did? He worked about 23 hours a day, took 20-minute naps here and there to achieve his life's work. You don't have to do that. As a matter of fact, I don't recommend that, but the good news is that there are fewer people right now, without sounding like my grandfather or maybe your grandfather. These kids, this generation doesn't want to work hard. But what I'm finding, when we try to go out and find staff, we're not finding it. It's true. It's real. And you're in the minority, and there's less competition out there that is willing to put in the heavy lifting and the hard work that it's going to take to get into your first deal or to grow a business. That's just a fact. So why do we work so hard? Well, we recognize that when smart people come together, we can change the world. So we're into a different phase. Right now, I'm not retiring because there is no such thing as retirement in the Bible, but we tend to do things a little bit differently as we get older. And so the goal had always been at some point to begin to flip the script. So 80% of the time is growing the business and working hard, charging, doing everything we can to do the biggest land grab that we possibly can with what we have in place, and then spend 20% of the time on the mission field-ish. Now we're heading into that phase, my wife and I, of significance, of impact, of legacy. And we want to flip that and spend 20% of the time overseeing the business, doing fewer deals, larger deals, and a team who we have groomed to step into the roles and make some of the decisions that we made so that we can go impact the world. If you want to go fast, go alone. If you want to go far, go together. And we have been living by that for years. There's nothing wrong with going out and doing this on your own, but we recognize that we can all go farther together for the reasons I just mentioned. If you can't do a deal on your own, you bring somebody in. That way you can go farther instead of just letting that deal fall off the desk because you can't take it on your own. Literally the tip of the iceberg. The education certainly doesn't stop here. I am continuing to learn each and every day, and I've been at this. I've been in real estate since '93, and I've been in self-storage since 2005, and I am still learning something definitely every week, if not every day, and that's because I'm a student of the industry, and I always will be. This is a simple, predictable business model, but don't mistake that for being an easy business, because no business is easy. And if you think there's an easy business out there, it means you're treating it as a hobby, and it's not going to be around much longer. Your hobby's going to go away. And that's an expensive lesson.
Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.